Many executives do this wrong, and it costs them tens of thousands of dollars at tax time. If you have a large RSU grant vesting this year, there's a good chance you're facing a federal tax gap and you don't know about it. Many people don't find out until April, when the year is already closed and the only option left is to pay it. A stock grant that turns into real shares in your brokerage account on a specific date. That's an RSU. And every executive I talk to understands the headline version of how they work. You stay, you vest, you get the shares. Where it gets interesting is everything that happens on and after that vest date. Because RSUs are not a bonus and they're not a stock option, and they don't behave like either one at tax time. If you're holding a large RSU grant that vests over the next few years and you haven't thought carefully about the tax mechanics, the withholding, and what to do with the shares once they land, you could be leaving a lot on the table. I'm Klemm. I'm the founder of Inflection Point Wealth Management. We work with corporate executives and high-earning families, and equity compensation is what we live in every day. This video is the first in an informational series on the major types of executive compensation: RSUs, ISOs, NSOs, ESPP, and performance stock and deferred compensation. For each one, the goal is the same. What is it? What are the common pitfalls? And what can you actually do to make better decisions with it? If RSUs are relevant to you, be sure to click below and subscribe so that you see the rest of our executive compensation series. So let's start with the mechanics. An RSU, a restricted stock unit, is your employer's promise to deliver shares of company stock to you at a future date once certain conditions are met. The most common condition is time. You stay with the company for a set period, and as you hit each milestone, a tranche of shares get released to you. The two structures I see the most often are a 4-year schedule where 25% vests each year, or a 3-year cliff vest where the entire award vests all at once at the end. Cliff vesting means no partial delivery along the way. You either make it to the finish line and get everything, or you leave early and you get nothing. The structure should be spelled out in your equity grant agreement. Here's the part that matters for taxes. On the grant date, the day they tell you you've been granted 4,000 RSUs, nothing happens. You don't own any shares yet. There's no taxable event. No paperwork, nothing to report. The units are just a promise. The tax event is the vest. On the day the shares actually delivered to your account, the full fair market value of those shares become ordinary income to you. Same as a salary, same as a bonus. It goes on your W-2. Federal income tax applies and FICA applies. So if 1,000 shares vest at $200 a share, that's $200,000 of ordinary income showing up on your pay stub that day, even though you never got a cash deposit. To cover the federal tax, most companies do something called sell to cover. They automatically sell a portion of your vesting shares to satisfy the required withholding, and the remaining shares land in your brokerage account. The default federal supplemental withholding rate is 22%, up to $1 million of supplemental wages in a calendar year. Above $1 million, the rate jumps to 37%. FICA gets withheld too, though Social Security caps at $184,500 of wages for 2026. So if you're already past that cap from your salary, only Medicare keeps applying to the vest income. And here's the thing worth knowing. The shares that actually land in your account after withholding, your cost basis in those shares is the fair market value on the vest date. That's the number you already paid tax on. If you sell immediately, there's no additional gain or loss to report. If you hold, any future appreciation or loss is measured from that basis, and the clock for long-term capital gains treatment starts at vest. That's the mechanics. Now let's talk about what I see that goes wrong. Here's what connects all three of these pitfalls. Your payroll department is set up to process your compensation, not to protect you from the gap between the withholding rate and your actual tax rate. That's no one's job unless you make it yours. Pitfall 1 is the withholding gap. This is one of the most common RSU problems I see, and it's the one that creates the biggest surprise at tax time. That 22% federal supplemental withholding rate is not your tax rate. It's an approximation the payroll system uses because it doesn't know your total income picture. If you're earning a couple $100,000 in base salary and a large RSU grant vests on top of that, your actual federal marginal rate is probably 32, 35, or 37%. Payroll withhold 22%, you could owe the difference at filing. Here's a sample scenario to put numbers on it. A married couple filing jointly, $350,000 of base salary and a $300,000 RSU grant that vests in the same calendar year. Total W-2 income of $650,000. That $300,000 vest stacks on top of the salary, so most of it ends up taxed at 32% and 35% under the 2026 MFJ brackets, with a small sliver still in the 24% range. When you run the actual math, the federal tax on that vest slice works out to roughly $97,000. Payroll withheld $66,000 at 22%. So in this example, there's a gap of about $31,000 owed at filing, just on federal taxes, just on that one vest. Pitfall 2 is concentration risk, and this one is less about taxes and more about your overall financial picture. Every year you let vested shares accumulate in your account without a plan, your net worth becomes more concentrated in one company, the same company that pays your salary. Your paycheck and your portfolio are tied to the same business, and that's not diversification, that's leverage on a single name. Now, whether concentration is working for you or against you depends a lot on where you are in your career and life. Think about two different executives. One is 35 years old, working at a tech company that's still in the real growth phase. Long runway ahead, decades until retirement, plenty of time to recover from a bad year. For that person, accumulating employer stock might be actually in line with their goals. They're taking intentional equity risk in exchange for potential upside, and time is on their side. That can be a reasonable position to hold. Now take a different executive. 58 years old, 2 years from retirement, the financial plan is built around preserving what's already been accumulated. For that person, every year of unsold vested shares piling up is a year where concentration is quietly working against the plan. A bad earnings print that week before retirement could reset the timeline in a way that's generally hard to recover from. Same company stock, same vesting mechanics, very different risk profile. The point isn't that concentration is always bad. The point is that it has to be a decision. And for a lot of executives, particularly those later in their careers, the default of just holding everything that vests is silently pushing them further from their goals, not closer. Pitfall 3 is the lack of quarterly estimated payments. When that withholding gap exists and nobody finds out about it during the year, the IRS could charge underpayment penalties. Those are calculated quarter by quarter, and they can add up. Many of the executives we see haven't been making quarterly estimated payments at all because their W-2 withholding has always been enough. In an equity comp year, that may no longer be the case. There are safe harbor rules that can help seek to avoid the penalty, but they only help if you set them up intentionally. The penalty on a $31,000 underpayment can run $500 to $1,500 or more, depending on the quarter. Not catastrophic, but entirely avoidable. And it compounds the surprise you are already going to get at filing. So what do you actually do about all this? First, project this year. Before January or at the latest in the early spring, you should know how much equity compensation is scheduled to vest in the calendar year, what your base salary looks like, and what your total W-2 is projected to be. That projection drives everything else. At our firm, we start this process in Q2, early enough to have real runway to act, not waiting until September when the options start to narrow. Second, compute the gap. Take the projected vesting income, apply your actual marginal federal tax rate, look it up in the 2026 bracket table for your filing status, don't guess, and compare that to what a payroll will actually withhold at 22%. That difference is real money you could owe. Decide whether you're going to cover it with quarterly estimated tax payments to seek to avoid underpayment penalties, or set it aside in a high-yield savings account and pay it at filing. Either approach can work, but the planning has to be deliberate. Third, have a sell discipline that matches your life stage. The tax is already paid at the vesting. Holding the shares afterwards is a separate investment decision, and it should be made for investment reasons, not because of inertia. One common approach is to sell a set percentage of every vest automatically, regardless of the stock price, and redeploy the proceeds into a diversified portfolio. How much you sell should reflect where you are. Early career with long runway and high conviction in your company, you may be comfortable holding more. Approaching retirement or already there, the case for reducing concentration gets stronger every year. The point is to have a rule tied to an actual plan, so you're not making the decision under emotional pressure each time. Fourth, plan around the big years. If you know a large vest is occurring, that's a year where charitable giving, deferred compensation elections, and 401k strategies should be in play together. Bunching donations into a donor advised fund, deferring income when the plan allows it, using the super catch-up contributions if you're between ages 60 and 63, these are the tools that could help soften the edges of a heavy equity comp year. None of them work in December. They have to be set up earlier. Here's the through line in all this. RSUs aren't complicated in concept. They're complicated in how they interact with everything else on your tax return and in your portfolio. The executives who get the most out of them treat each vest as a planning event. They know the gap before the vest happens. They have a selling framework tied to their actual stage of life, and they coordinate the rest of their financial picture around the years where equity compensation is heavy. Executives who don't do this can leave tens of thousands of dollars or more on the table in a typical vest year. In the next video in the series, we'll walk through non-qualified stock options, NSOs, which are a completely different instrument with their own rules, their own traps, and tax treatment that works nothing like RSUs. If you have RSUs vesting before December 31st and you haven't projected the withholding gap for this year, that window is still open, but it closes at year end, and the gap doesn't shrink after that. It just becomes a bill. This channel is built for high-earning professionals and executives, delivering content on navigating complex financial decisions, equity compensation, tax strategy, retirement planning, and concentrated wealth. If these topics are valuable to you, be sure to subscribe so that you get more free content. Thanks for joining, and I'll see you next time.